In this video, as well as two subsequent recordings, we're going to tackle the topic of cash flows. And this is going to be an introductory series of 3 videos on the cash flow statement and the intuition behind it, especially the intuition behind computing cash flows from operating activities. So if you want to get this critical aspect of the CFA Level 1 curriculum right on the exam, do keep watching and let's get solving. So this is the long scenario that I want us to have a go at, and there isn't even a question accompanying this scenario. So I'm going to perform various calculations in this and subsequent videos based on the scenario, which will then help us solve actual questions in subsequent videos. Have a look at this. A company presents the following income statement in respect of the year ended 31st of December 2023. As well as selected items from a balance sheet prepared as at the same date. And we've got the 2023 income statement culminating in a position called net income, so net profit, and then items or selected items from the balance sheet for the year ended 31st of December, 2023, and 31st of December 2022, a set of comparable figures. Selected items from assets, selected items from current liabilities, and then additional information concerning the composition of other operating expenses. So up here in the income statement, there is this line, other operating expenses, and point A down here talks about what other operating expenses comprise. Depreciation of property, plant and equipment, 36,000, wages for the year, 42,000, and a 6,000 gain from the disposal of a fixed asset, C point B. During the year, the company sold one item of property, plant, and equipment, which had a carrying amount of 18,000 at the date of disposal. The result on the sale has been offset against other expenses. Okay. More on that when we come to this point, which will not necessarily even be in this video, because in this video, this initial one, what I want to discuss is the first component of the cash flow statement. And as many of you will know, hopefully, the cash flow statement comprises 3 components: cash flows from operating activities, then investing activities, and finally, financing activities. We won't do all 3 even in this series. We'll only touch on 2, but the first 2 videos will actually be devoted to that first critical component of the cash flow statement, and that's cash flows from operating activities. And operating activities, as many of you will appreciate, are the sort of day-to-day activities, business as usual activities of a business. And you should know that this can be performed, or this computation can be performed using 2 methods: the direct method or the indirect method. And in the exam, which is test-based, you won't actually be told, please use this method or that method. However, based on the data you're provided or the way in which it is presented, only typically one of the methods will be eligible or can be used. So I'm going to start with the direct method of doing this. So this is the direct method of computing cash flows from operating activities. And in the next video, I'm going to do the same thing. So compute cash flows from operating activities, but using the indirect approach, which is more commonly used in real life. We'll get the same result. It's just a different way of doing the computation. Now, under the direct method, what happens is we write out, or we compute and present line by line the different ways in which the company generated cash inflows associated with its operations or operating activities, and what it's spent money on, cash on. And it's absolutely natural here to start with cash inflows from our customers. Now, inflows from customers are the results of sales, right? And we can see that the company generated sales of 1,200,000 in respect of the year 2023. Now, let me just say that we're doing this for the year or in respect of the year 2023, so that there is no doubt concerning this. Now, sales alone do not equate to cash flows. When a company makes a sale, it typically also issues an invoice and records accounts receivable. And what you need to kind of become aware of is the need to do something that I'm going to call workings. So additional computations which will take into account the fact that certain income statement items such as sales revenue correspond to certain items within the balance sheet. And in the case of sales, it's going to be this line, trade receivables, for which we've got numbers for 2 years, in respect of 2 years, or at the end of 2 years, 31st of December 22 and 23. We're going to assume that whenever a sale is recorded, an invoice is issued, and the client has some time to pay. So they receive an invoice, and maybe they've got 30 or 60 or so days to pay. This obviously is not an assumption that in reality holds all the time. Certain companies make a great many of their sales on cash terms, so they don't issue invoices, but clients pay immediately using cash, for example. Even if that assumption is unrealistic, the workings I'll show you, or the approach I'm going to show you, will still provide you with the right answer. So don't worry about the reality of that assumption as such. What I'm going to say is that over here, we've got our trade receivables account or line. Don't worry, we're not going to do this in debit credit, so typical accounting terms. I'm just going to say trade receivables, and I want to make sure that I correctly show the opening balance, meaning the size of the carrying amount of this line, which was 235. That's at the end of 2022. And then by the end of 2023, this grows all the way to 259. That's our closing balance in respect of the year 2023. So there's growth. Now, there is an increase, but it would be too simplistic to say, well, it went up. Why did it go up? Well, trade receivables go up and down as a result of certain specific activities or transactions happening. First of all, I'm going to assume that whenever we make a sale to clients, we issue an invoice, and if you issue an invoice, it gets recorded as a trade receivable, at least temporarily, until it is paid off. So trade receivables during the year 2023 went up as a result of issuing fresh invoices, which are a side effect of conducting sales. And we know the complete value of the sales that were done. It was 1,200,000. So I'm going to show that this is 1,200,000. And this is sales from the income statement. Now, why did we end up at this level, 259? Because a lot of that money which clients were owing to us was actually paid. So receivables decrease whenever clients pay us the money owing. So cash goes up within assets, and accordingly, accounts receivable or trade receivables go down. So this is the cash received from clients, which is basically our missing item, and the item I'm looking for here, inflows from clients. And it's a relatively simple computation now, because we've got pretty much a closed system. Now, in reality, there are other things that can influence this as well, such as write-downs of receivables, impairment of receivables, so various subjective deductions when you believe a client can't pay you and will not pay you, but this is not the case here. So I'm going to say that cash received from clients is going to be a simple computation. 235, this opening balance, this starting point, plus 1,200,000 or 1,200, and minus 259, so the figure which represents the closing balance. That is a formula for the unknown. 235 plus 1,200 minus 259. Okay, I'm looking at an answer of 1,176 or 1,176,000. If we make this downward pointing arrow equal to 1,176, we've got a balancing trade receivables picture. So 1,176. Alternatively, I could have said, and this is just, an easy shortcut, that this figure may be computed as whatever we had for sales, 1,200,000. So sales revenue minus the growth in our accounts receivable, growth of accounts or receivable or trade receivables account. Because whenever accounts receivable increase during the period, that kind of signifies or symbolizes more cash which remains unpaid, as at the end of the year or end of the period, corresponding to what was there at the beginning of the period. A growth in accounts receivable always is kind of detrimental to your cash position. It means money to still be received from clients. Now, this growth here is, from to 259 from a starting point of 235. This is a 5. So what is that? That's going to be growth of 24 plus 24 here. Okay, let me work on my digits. 24 and 1,200 minus effectively this 24, once again, results in 1,176, which confirms the previous computation. This is an approach which is going to be useful when we later switch to the indirect method. Okay, so we've dealt with the obvious item, inflows from customers. Let's now focus on outflows. Outflows incurred as part of our operating activities. Now, these outflows will be of two types. Outflows to suppliers, because we obviously settle certain liabilities towards our suppliers of materials, goods, whatever. And I guess there's going to be also outflows to employees who receive wages. And we'll deal with these one by one. Let's start with the more difficult one. That's outflows to suppliers. Okay. When it comes to the cash that we actually pay to our suppliers, I'm going to introduce yet another item of workings. So maybe over here, workings. And the most obvious place to start is to have a look at trade payables, because this represents the amounts which we as a company owe to our suppliers. So trade payables or accounts payable, and we do something similar to what we did in the previous video, meaning we compare what's happening to this account at the beginning of the year and at the end of the year, or respectively at the end of 2022 and end of 2023. So our opening balance, now this is a reconciliation of what happened to this account in 2023. So our opening balance was over here, 138. Sorry, apologies for that. 138. Our closing balance was over here, 168. So there was a little bit of growth here. However, what happened? Well, during the year, there must have been some additional purchases from our suppliers. But what makes this account ultimately drop to its level, end of year level, was the fact that we paid some cash to suppliers. So cash paid to suppliers. And this is the figure I need to input into my cash flows from operating activities. However, in order to solve for this, I still need to know what the purchases were. And I'm not told what purchases were, unfortunately, but I can work this out by looking at the inventory account. Because inventory is where we store purchased items, especially if you assume that this is a business which, for example, just does wholesale buying and selling, so it just trades, it doesn't manufacture anything. And such simplifications, although maybe unrealistic in real life, they do help from an exam perspective to get the right answer. And they will not hurt your, the validity of the solution. So looking now at the inventory account to help me with these computations, same story. I'm looking at the opening balance of inventory. So over here, opening balance at the beginning of the year, still looking at 2023, was 140. Whenever you are presented with balance sheet data, which is going to be very typical to do cash flow, you will get numbers for the 31st of December, typically end of one year, and also the end of the previous year. And it's very, very important to understand and get it right which year is the preceding year and which year is the final, which year comes first and which year comes second, because people often get the order wrong, and therefore they get their opening balance mixed up with the closing balance. So just a word of warning on that. So closing balance here would be 160 for inventory. Good, a bit of growth. And how does the inventory account work? Well, when we purchase additional items from our suppliers, that causes inventory to grow. So this is purchases, and it's actually going to be the number I'm going to be looking for so that I can feed this computation up here. However, why does inventory fall? Well, inventory fall because we sell items that get delivered or sent to clients. And I know the value of the items sold during the year which went to clients, because in my income statement, I've got the cost of sales. Cost of sales is the cost, or how much it cost my business to purchase the items which were delivered to clients or sent to clients or sold to clients during the year. So cost of sales is the figure I'm looking for here, which was 840. And now I can easily calculate my purchases. If my inventory started at 140, finished at 160, and during the year I sold items to clients which had cost me 840. So this is how much was taken out of inventory. The only way in which we're going to experience this year-on-year growth is if our purchases were 20 higher, or higher by 20 than the cost of sales. So purchases must have been 860. There's no other way to sell goods worth 840 and still experience growth of 20 within inventory. So 860 gets transferred over here. This is the value of the goods which we bought from our suppliers. And now it becomes quite easy to compute the cash paid to suppliers, because we have just one unknown here and the whole system is kind of already set up. So this is 138 plus this 860 within purchases minus 168. And what's this going to be? Let me take my calculator on my phone. 138 plus 860, but minus 168. Well, it gives me, or it's showing me, an answer of 830 cash paid to suppliers. Okay, fine. Now, once again, another way to think about this computation is that if you know your purchase is 860, and you're looking for cash paid to suppliers, and you know that trade payables grew by 30 year on year, it must mean that the cash payments to suppliers must have been lower than purchases by an amount equal to 30. If the two were equal, cash paid was equal to purchases, there would have been no change to the trade payables line in the balance sheet. And this is an observation that we can actually utilize in terms of computing the outflows to employees, because we are told that other operating expenses over here in point A comprise depreciation of property, plant and equipment, but also wages for the year equal to 42,000. Now, Looking at the balance sheet, I see wages payable 12,000, same amount year to year. So at the end of 2022, we were still owing our employees 12,000 of wages. And at the end of the next year, we continue to owe them 12,000. Now, it doesn't have to be the same 12,000. Maybe we paid that one, but we now owe them a fresh 12,000. Still, if there is no growth within the payables account, that means the amount paid must be equal to the expense. Equal to the expense in terms of wages because of no change to the relevant payables account. So I can with confidence state that outflows to employees must have been a figure of 42. Now, these are obviously outflows. Up there we had an inflow, so let's compute the end result. 1,176 minus 830, 1,176 minus 830 minus 42 gives me a positive result for cash flows from operating activities of plus 304,000. And this is where I want to stop this video, because in the next one, I'm going to replicate the same answer, the same solution, but using a different approach called the indirect method.